Now a look at how the banking crisis is affecting small businesses. Regional mid-sized banks are the go-to fuel for small to medium enterprises, providing about half of all business lending. But if you're a small business, is a move to long-term debt the right one to hedge against exposure to the financial sector? We're here with more Loreen Gilbert, WealthWise Financial CEO. Good to see you, Loreen. So obviously we do have a lot of different camps sort of trying to figure out what the Fed is going to do next, how long this banking crisis is going to play out. Where do you see the opportunities in this environment?
Well, there are a lot of opportunities. And what I think a lot of investors are going to miss is we now have Treasury Secretary indicating, in effect, that there's a backstop. And there's this new banking program that is going to offer $2 trillion to swap out securities out of banks and give them cash. And with that, that's effectively another way of saying QE, quantitative easing, versus QT, quantitative tightening. And with that, QE offers a tailwind in the markets. So with that, I think that we are going to see a tailwind. I also think as far as looking at fixed income, longer duration assets, both on the income side as well as the equity side, are going to benefit. So what does that mean? That means going out longer in duration on fixed income and looking at some technology names that benefit from long duration assets.
And Loreen, as you mentioned, Treasury Secretary Yellen there, obviously really focusing on these banks that have this systemic risk in terms of the ones that would qualify potentially for another backstop, SVB style. But then you also have SoFi offering access to up to $2 million in FDIC insurance for checking and savings. So when you have some of these banks sort of doing their own thing, and you also have this idea that some banks, the ones that have more systemic significance, are also in the picture to get more protection, what does that do then in terms of the investment landscape?
Well, it's good that we have banks that are offering the kind of security that people are looking for, because what is going on right now is there's a lot of money movement from the smaller regional banks to the large national banks. And with that, that's going to cause more stress to the regional bank system. So with that, a lot of the regional banks are talking to their clients, letting them know what additional security they may be offering. But from an individual or a business owner, they do need to be looking at their bank. They need to be looking at the strength of their bank and seeing what guarantees do they have. And if they're holding excess reserves more than $250,000, they need to know if there's any additional assurances. Because there hasn't been, that's where we're seeing a lot of movement. So from an investment landscape, I think there's still quite a bit of fallout for regional banks. And I think that there needs to be caution around trying to invest in that arena until some of this is sorted through. Of course, looking at the details, looking at the balance sheet, looking at the 10Ks, if you're interested, you can look at those publicly traded banks to see the strength of those banks. And with that, because there's been such a fallout, there are some regional banks that are quite strong that are being impacted on their stock price. So there could be that opportunity, but I would say you need to be cautious in the area of regional banks.
And I mean, even when people have been looking for safe havens, usually it's bonds, but when you think of the inflation risk attached to that, makes it less of a safe haven here. Where do you see the safe havens when you do have this sort of backdrop?
Well, the backdrop that we're looking at is most likely going into a recession. And so thinking about defensive areas of the market, like consumer staples, and being careful with valuations in that area, and then looking at healthcare as another defensive position. And then selectively, like I said, areas of technology, I think could be a valuable play as well. But definitely looking at a defensive measure when it comes to equity exposure.
And Loreen, what are you steering clear of at the moment as well?
Well, I think we're steering clear of utilities and areas that are more cyclical. Those would be areas that we are avoiding right now. Another area I will say that could have opportunity are real estate investments that have already been impacted by a fast interest rate increase environment and those rate hikes, and now offering long-term leases, and some of those companies could be attractive as well.
Of course, all eyes going to be on that Fed announcement that's coming out today. I mean, a lot of people, just the difference a week makes, we're all in on a 50 basis point hike. Now we're at the 25 basis point hike point. But would anything other than a quarter point hike, say a pause or a cut, what would that do to markets?
Yeah, I think that could be harmful in the sense that it would let the markets know that they're not really as serious about taming inflation. And so, and that could be problematic longer term. So I think it is 25 basis points, and you're absolutely right. We keep moving. The ball keeps moving. We thought it was going to be 50. Now we're back down to thinking it's going to be 25 after the banking crisis that we've experienced in the last few weeks. So with that, I think the Fed needs to stand firm, saying, look, we're still fighting inflation, and balancing it with we're not going to try and destroy the economy and destroy the banking system. And so that is that fine line that they have to play, but 25 basis points could do that.
All right, we'll certainly be keeping an eye on it. Loreen, Gilbert there, thank you so much. WealthWise Financial CEO, thank you for your time this morning.